All right, I'm back from a very long road trip to be able to do the market forecast here tonight. Going into the last 2 days for this week. Very, very interesting last 3 days. So I'm going to kind of break this. I had a 3 day or two market outlook videos for me because Monday and Wednesday in one, kind of piled up in one here. And of course, I've been gone for most of this time. So I'm catching up myself on a lot of this. So our premium subscribers have seen the telegrams, the trades that we've been pushing through. At least I've been pushing through while we've been gone, while I've been gone. But a very interesting market situation over the last 2 weeks. I'm going to break that down. I'm going to break down this continued discrepancy, this parabolic discrepancy in large cap tech and small cap stocks. It's really been going on for a good 6 weeks now. What that means and when we, how extreme it is now, and when we've seen this extremes before, and what that can mean, and some of the signals that we're seeing on the Russell 2000 is as bearish as it's been. Has it been bearish enough to mean anything? And so we're going to break that down in a video as well, and then take a look at a trade idea of a stock that's had a really good parabolic run to the upside, kind of along with this large cap tech space. And so how can we trade it now that it's had this parabolic move, and what can we do going forward? So I'm going to show you that with our trade idea today. So let's go ahead and get started. Today is Wednesday, July the 15th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator like we always do. And you can see the flat moves we've had over the last few days. Very strong close to the week last Friday. And then, moving up on Monday, but then kind of staying in the same range over the last few days. Actually, today's range is the biggest. We had our highest high of the week today. We also had the lowest low of the week today, not well, even including the gap small gap that we started off with. As a result, we're not getting very much of an intermediate change. The intermediate line is still very strongly bullish. It's going to take more than that to break this intermediate posture. Market sentiment's falling, but still very, very close to 80. So take that with a big grain of salt there. The momentum line yesterday. The momentum line got down to near extreme levels, got down to the 5th percentile. Usually when you get to extremes, that's a sign that things are changing, that the intermediate line's run and the reversal zone is done. Doesn't mean that it won't stay down. As you can see, we were only down just a smidgen there before it turned up. But the near-term line, you notice, also still hasn't gotten out of the reversal zone yet. So this near-term run that we've been on, starting right here. This is this day here is the first day we got above 50 because we were at 45 there. So above 50, we are also above 60. So we're in the bullish territory. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 15 days in that bullish territory. 16 days in the upper half of the chart. It's a very long near-term rally. So not surprising that we get, even with a little bit of a dip there. All that did was bring the near-term line down for a day, right? And then we bounced back up, obviously, on Friday and so far this week. So it is the lowest point of the week for the near-term line. More than likely, we're going to finish in the reversal, in the lower half of the chart. The momentum line is in the lower reversal zone. Combine that with a strong bullish posture. That's a short-term bullish signal. You can actually see this ended up being one, even though it was extreme. The intermediate line was still in the reversal zone, and we bounced up. So, there's not much of a decline here, and the fact that we've been up for 15 days makes me a little skeptical that we would jump up again with a good bullish jump here off of this oversold momentum line. But, again, can that keep us from having a significant decline into the lower half? Now, keep in mind that we've got now, 2 days with the momentum line down here at these low levels in bearish territory. And the more bearish, the more time you spend in that bearish territory, not so good. Now, keep that in mind that, when we had this run, this bounce, we did stay in bearish territory this whole rally until we got this jump higher. So we might not drop, we might grind up a little bit here while the momentum line stays enough to bring that near-term line down, and then down a little bit more into this lower half of the chart, maybe into this bearish territory. And then, like the last few times when we got the near-term line in this bearish territory, we just jump right back up. So we'll see if that ends up being the case again. The Dow Jones Industrial Average looks very similar, though the momentum line not nearly as extreme. The NASDAQ, of course, which is the driver of all this, is very similar. Keep in mind that the NASDAQ's got this, pretty extreme divergence. Well, not too extreme, but pretty significant divergence with these lower highs and the higher high coming into the end of this near-term run. I mean, like, this entire time has been a near-term rally. One little dip right there that pretty much brought the near-term line down below 50. Didn't quite get it below 40. So this has been a very strong near-term rally, that we've had here, way longer than even the S&P 500 has been. And then finally the Russell 2000 which the short-term sentiment there looks very bearish. Now, granted, the intermediate posture is also bearish. Like, we got dark pink shading in a red line. The intermediate line's below 40 again, like we were here, like we were here. Now, very similar to these two. We still haven't crossed the 23% retracement level yet, so we still haven't really broken down. And keep in mind too, about where that 23% retracement level is, there is a significant level of support there. We break that level, and we are really headed lower. Like, there's no support until you get down past this 38% retracement into the retracement zone. That's why, again, that's why we're in our class portfolio. We are more concerned with the margin of safety on the Russell than we are with the Qs, which doesn't have that problem. Right? The Qs has a very significant volume of support down here, level of volume support. Excuse me. Now we can drop, but it's got something holding it up down below it. Russell 2000 has the bulk of its volume over the past year up above it right now. So all this volume here is trading up. That's what's making it hard to really get it going. And while it's actually kind of like the path of least resistance right now is to the downside, and you can see the bandwidth rising. We'll come back to that here in just a minute. But so strong bearish posture, very, very bearish. In fact, that's the most bearish that the short-term sentiment has been since this day, which actually ended up being the day that the lowest low point that we got. So, just kind of keep in mind whether or not this is actually the beginning of an intermediate posture or like we saw here. Now, the difference here is we weren't bearish. We weren't in bearish territory. After we bounced, the intermediate line just made a little run below 40 afterwards. It lagged in a lagging move. Here, we are already below 40. So that's pretty significant in that we are already in bearish territory for this intermediate posture. And while we're here getting the strong short-term sentiment to support this new posture. So in my opinion, so take this for what it's worth, this kind of tells us that there's more to this bearish run than what we saw here, where the bearish short-term sentiment was before, and here where we never did get that strong a bearish short-term sentiment to confirm the move into bearish territory on this intermediate line. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, that you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our videos. Of course, if you don't like our videos, you don't have to click on anything. But you don't even have to watch. But if you do like our videos and you want to let us know, you can do that even right now while you're watching with one click down there. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have about anything I brought up? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, come over here, check out some of these things on the right, including some of these posts over here. These are our more popular posts. You can see a few of our resources for our premium subscribers here listed. As well as our upcoming trading rooms. Our Q&A sessions are also for our premium subscribers. But all of our subscribers get access to our trading rooms. This is my classes I have coming up this week. My long-term portfolio management class tomorrow, and then my technical analysis class on Friday. Also, you have the Market Outlook Live. In this video, I review all the trades that we've been doing in these Market Outlooks. I stay with them. I don't just tell you something and forget it. We actually trade them, and we stay with them, and we manage them, and we close them. And this is where we do all that in that video. I also put on, usually, I didn't do one today because we didn't have one. I just barely got back from vacation, so But usually when I do this video, I also do this. I put on today's trade idea that we'll do at the end of the video before the market closes. And we'll do that as well in that Market Outlook Live. You can get to that here. All of our subscribers get access to that. So make sure you check that out. Come down here to the bottom of the video, or scroll down to the bottom here. Click on that heart. It opens up a new tab. Hit that like button right there. Also hit this thumbs up icon. Opens up another new tab. Hit this like button right there. Again, the more you do that, the more people will see our content because the more engagements it has. So we really appreciate those who do. Thank you very much for that. But for everybody else, again, it goes a long way for us. Also, it helps you because Twitter and Facebook will promote content in your timelines on Twitter and Facebook from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. So you can also, one of those things you can do while you're watching the video as well. As Brandon and I have said before, considering we do these videos for free, that's a small cost. If you want to help us out, you can donate just the effort of a few clicks. That goes a long way to helping us when you click on the likes for YouTube and for Twitter and on that Facebook page as well. All right, let's check out the rest of these charts. If you take a look at the long-term view for the S&P, which still has a very high PPO, mind you, you can see the kind of candle, still very bullish candle. The low was at the open, 43.07. We're at 43.74. So you see, we're still not anywhere close to getting a bearish candle here on the Dow or the NASDAQ, especially the NASDAQ. The low there is at the open at 14,529, and we're still almost 400 points away from that. We were up 26 today, so it kind of gives you some perspective. Of course, that's not the case in the Russell, which again is, just like these other two times that I mentioned before, that got us the dark pink shading in the red line on the in a drop below 40 in the intermediate line. They gave us red arrows on this index, which is typical of a pullback too, and we got one again. So it kind of shows just how more bear. And again, despite this crazy weakness we've seen in the Russell, the PPO is still higher than it is for the S&P 500. So the S&P 500, which has been on this crazy bullish, steady bullish trend at very high momentum levels, this is like really high, like for its history. When you compare that to the Russell is actually still higher. This, even with this really sideways action and with the PPO essentially getting cut in half, it just goes to show just how parabolic the Russell had gotten and why we're going sideways on it and why we're hedged against this particular index and not the S&P or even the NASDAQ, because you can see that the Russell still actually got a higher PPO than the NASDAQ, and the NASDAQ's PPO has been rising to get to 8.8. So again, it goes to show how bullish, how crazy bullish the Russell was, and how much of, what a poor margin of safety it has because it rallies so much so fast and now has a really significant level of resistance up here above us. Let's take a look at the 3 green arrow chart, and you can see that we have 3 green arrows. You notice we're losing that momentum. We talked about this in my technical analysis class last Friday about how this momentum, how this MACD works, and we talked about how we were on this stage where you're still bullish, but the MACD is dropping until we get to that red arrow. This is what it looks like here. So the MACD is about to cross over. You can see it's starting to drop. It looks like we've peaked on the MACD potentially. It hasn't crossed below a moving average yet, and you can see when it does, then it doesn't necessarily mean we have to fall either, but because we're still relatively high compared to 0, we weren't nearly as high there, so we broke below the moving average quickly. So keep that in mind that we've got that first stage of a positive momentum where that positive momentum increases and the positive momentum still decreases, but still positive momentum, so we're still rising. Now we're going to get some negative momentum, but that doesn't necessarily mean that we're dropping. You can see the whole time we were negative here, we continued to rise until we finally broke. The MACD got close to 0 and we broke down. So, and that's when things kind of changed. To kind of show you where we are in that stage for the IWM, we broke into the negative momentum a long time ago, and we're well below. So vastly different scenario on the Russell 2000 than what we're seeing on the S&P 500. And when you look at it here too, when you throw on like how far below the 30-day moving average we are, which is another indication of whether or not we're actually in an intermediate decline or not. You can come down here and you can see we're 4% below. Down here, the lowest we got, which were relatively low levels for the year, right? If I were to go back 10 years here, not so low because of this big drop there. But just in the last year, you can see we're in the 12th percentile. We had lower levels over here when we were actually in an intermediate decline, and then these two got to 5% and 5% there, and we're up 4%. So we are in all these others that we didn't quite break down. That got to 3% or 2.8. This got to 2.74, and of course you can see over here we are 2.9. So it seems like 3% is the mark of where, okay, now we are actually, over here we got to 2.93. So we were really close, and 3% seems to be the mark that suggests, okay, we are in pullback mode. And if that's the case, we're below that. We're at 4% here, just like we were in these two very brief pullbacks that we had in late March and early May. Let's take a look at some of these other oscillators. The RSI and the CCI still at bullish territory for the S&P, obviously for the NASDAQ as well. Extremely bullish territory for the NASDAQ, though that CCI shows you that we are diverging with weakness here. The Russell 2000 is a different story. We are now in bearish territory for the Russell 2000. Again, similar to what we saw in late March and early May there. So it's a very different story there. Directional movement index is still bullish for the S&P 500. Parabolic bullish for the Qs, which are that ADX is getting to very, very high levels. And then IWM, we are going parabolic, but in the bearish direction. That is definitely a trending breakout move to the downside. Again, a little different than what we saw over here, because you can see if here's that late March level, there's the early May level. We never did get above 35 in either one of those times. This time we are getting above 35. In fact, both these little legs we've gotten above 35 as we are well below 20, and the ADX is really making a move to the upside. Take a look at the trend strength indicators. Of course, you have close to a very strong trend on the S&P, and the Qs has a very strong trend. But the IWM now is developing a weak bearish trend, probably the strongest. Again, you can see March, there's that late March. We never did get above 50 during that late March decline. And then over here in mid-May, we got up to 50, almost 55 on the trend noise balance. And we got to minus 1.2, well, we're at the 1.3 and 57 now. So this is, and we're below the cloud like we were in May. Unlike March. So this is a little bit more bearish on this indicator than what we've seen in the previous levels. There's your S&P trading still in the upper quartile of the range. The QQQ definitely in the upper quartile of the range. IWM on the other hand in the lower quarter. After a couple moves back to the upper end of the range. Today we are right on the low, the Bollinger Band. That's why 0.34, I guess. Pretty much right on the low. The bandwidth is rising as these lines separate, breaking below the point of control. Very significant level of volume above us now. So really, really pushing things to the downside. So pretty bearish patterns on the Russell 2000. That if this were on the S&P 500, we would definitely be in pullback mode. Like, these indicators tell us that we're in pullback. The only thing that's not quite there yet on the Russell, really the only thing, is that we're not below the 23% line. Everything else is telling us that the Russell is in pullback mode, similar to what we saw over here, but again with different levels of bearishness now than what we even saw in May when we were close there. So we're even though we're still not below that 23% line yet, we are getting more bearish indicators now than we did then. Now let's take a look at today's volume. You can see the intraday range here. There's the S&P 500 filling into this morning's gap. We still got this gap there to fill in from last Friday. That's a common gap. Again, not the case in IWM. We are flirting with a new low, which will push us back. We've already got the bearish crossover on the Arun indicator where we made it up to 100. This would just get us back to 100 again. Again, that would be relatively bearish. The positive is not too far down, so you can see when we're on a bullish trend, the positive is up high, the negative's down low. You have to really go back for a while to see what a negative trend looks like. This is a negative trend, and it usually runs out of gas when the high gets over there. That's an intermediate pullback there. If I were to go back here, let's go to SPY. There's the bearish decline. So again, ran out of gas. Made another leg lower there, but again, even that was done. And by the time we got that low point there on the positive, we were starting to break out. I have to go back a few years to see other bearish declines. So here is the COVID low point. Obviously, you got a bearish level, and then the positive was over here for a while. So we were really bearish. By the time we got way down here, that's when the 4-week low, that's how fast the decline was. We had dropped that much by the time the 4-week high point got to the first day of the 20-day period. And that's usually when it runs out of gas, and that's actually when it did run out of gas at that point. If I go back to some of these other levels, so these were ordinary intermediate pullbacks in 2019. Again, you can see by the time the green line got to 0, we hit these levels. By the time the green line got to 0, we were down. We were done with that intermediate decline. So it kind of gives you an idea. IWM, the green line is not quite. It did get down there, and that's kind of when we stopped this. But now we're rolling back over again, and over here we never did get the move up to 100 on that negative. So now we got to move to 100, and we'll see how far this high point works its way down. So needless to say, this is a relatively bearish pattern that could get more bearish tomorrow on the Arun indicator. Not quite on the S&P. I mean, we are right up against the high. I mean, that's actually a really bullish Arun indicator for the S&P 500, and the negative hasn't gotten down here yet either, which again, kind of you can see when you're in these bullish moves, the negative can get towards 0 and stay below 0 for quite a while, or stay at 0 for quite a while. And that's been the case for the NASDAQ 100. Very, very bullish trend. So very different scenario than what you're seeing here on the Russell 2000. You look at today's volume and trading range. The volume picked up 64 million. The trading range, though, stayed really small at 3 points. So when you put those two in context of their averages, then 64 million is a little bit below the average. That's rising, and 3 points is below the average there. So, and we're at extreme lows. In fact, you can see finally the weekly range is getting to close to extreme lows for it, which is about 2%. Is its extreme. You can see in 2017 it stayed below 2% for quite a while because we were so extremely low. So very, very low range for the weekly S&P 500, and of course the daily is just extremely low there. It's, if I were to go out, at least try to go 10 years on the daily chart again. We were there going into the COVID low. Some other periods of time we were there that kind of signified the end, but that preceded these intermediate declines when we got pretty much this low down to the 75th or 70th percent mark there. And then you take a look at the volatility, and now this is what's interesting. Volatility is just flat. It's like not there's as much weakness as we're getting on the Russell. It's not translating to volatility in the S&P 500, which is what the VIX measures. It's still extremely low, and I tweeted this out that we are really, really close to a really bullish environment for volatility. With the options expiration cycle close to ending here, you can see it's been 2 consecutive expiration cycles that we did not get an upper shadow, which is very rare. Usually leads to a good bullish move coming out of it, like when we don't get very much of one, and you got one here. So it usually leads to a long upper shadow. So we've had 2 in a row. What's distinctive about this one versus the last one is the last expiration cycle volatility finished. There was a long lower shadow, which is very, very rare. Usually volatility finishes at the low of the cycle, not the high, as you can see with all these others. But this time, now we're back to potentially closing the expiration cycle at an extreme. We've got 2 more days left, so we'll see how things end up. But that would be a significantly low level for volatility, and in the past has definitely led to bullish moves when we've been this extremely low without a long upper shadow, which means an intra-period volatility burst, even if it was only up to the 30s. But you can see pretty much every options expiration cycle has one. except for the last two, which means, when we get one, it usually leads to one the next time, especially when volatility is low. That wasn't the case last cycle, but it is the case this cycle. So we'll see how that plays out into the next options expiration cycle that starts coming post July expiration. Longer per shadow means you usually get the volatility jump early in the cycle and then finish lower late. So, which means post July expiration we might be due, and that is the seasonality. I think I've shared with you this chart before too, but that is the seasonality for the VIX. Like post July expiration is when we generally get a run on volatility that doesn't end until we get to about the beginning of November. So the volatility usually makes a run. Of the last 20 years, on average, the VIX makes a pretty decent run. Like from being down for the year about 7%, which we're down 40% for the year. So to being down for the year, to being up almost 20% in the year. So this is generally a significant time for increased volatility in the S&P. So we'll see if the seasonality plays out again this go around, especially considering that we are setting up for this type of move with where we are currently closing this particular expiration cycle. All right, I'm going to summarize, before we look at what's driving the market in our trade idea of the day, I'm going to quickly summarize this technical outlook. So it's a lot. We just talked about a lot. So in summary, the thought is, again, this two-headed market has been really going while I've been gone, and now it's kind of getting to an extreme where the NASDAQ, and you'll see that here in a minute, the NASDAQ is really bullish, and the Russell just really is completely opposite. Like they're not even just kind of moving in the same direction, just in different degrees. They are moving in opposite directions, and the Russell is in pullback mode across multiple indicators, except for the one, the Fibonacci retracement break, but everything else is telling us the Russell is in pullback mode, and the NASDAQ is still in very, very strongly bullish mode. So when is, something's going to give, and that disparity, which is not very common, something's going to give there. And considering the length of this run the NASDAQ has been on, which has been a short-term run that's really been extended, like the near-term run, the blue line in the market forecast has been on this bullish territory for a very long time. The S&P kind of broke that up a little bit, but the NASDAQ's been really bullish, considering the maturity of not just the intermediate run on the S&P, but also the maturity of the short-term run on the NASDAQ. I would venture to guess would be the Russell that would, or the NASDAQ that would eventually give. Is it going to give tomorrow? Doubt it. Is it going to give Friday? Doubt it. I still think that we're going to finish the week in very low volatility mode, but that's going to set us up in time for the right season for a jump in volatility over the next couple of expiration cycles, 2 or 3 expiration cycles, with generally that include long upper shadow, which include big jump that pull back, but then another big jump. And so that typically is associated with weakness in the S&P 500. So just be prepared, right? It doesn't have to happen tomorrow. It might not even happen on Monday. Most likely it won't happen on Monday. But as we enter a new expiration cycle where it's seasonally likely and the setup is there, it's something we can expect at some point in time. So does that mean I sell right now? No, obviously not. But we definitely need to be prepared for that type of move while we continue to ride this bullish trend. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at to tell you why you're a lot more broadly bullish than I am, or that you're a lot more bearish than I am, that you're looking for a big time drop to the downside? Share with us in the comment section below what you're looking at. All right, now let's go ahead and take a look at what's happened today, what's driving this price action, not just today, but this week that I've been gone here. You can see the big difference here, and it's really like everything else is kind of matching. EEM is performing as same as QQQ, so it's not just a mega cap, large cap tech move. EEM is up there too. Commodities were doing well for a period of time. They have since rolled back down as bonds, which were weak, have rolled up. So a little risk off move, back to a risk on type finish of the week, with gold really finishing strong so far in the week. So really small cap stocks are kind of doing their own thing right now. Like it's not completely opposite, and it's not like the Qs are doing their own thing. As you can see, other equity asset classes internationally are following along. So it's really a main, at least for the last few days. Now again, go out a few weeks here, and if you go out say 1, 2, let's go out to we'll go out to 6 weeks. I'm going to show you a 30-day correlation here in just a minute. So 1, 2, 3, 4, 5, 6. So here's a 6-week time frame on how the different asset classes are performing. So now you can see over this time frame, QQQ has been doing literally its own thing, because QQQ is up nearly 9% in that 6-week time frame, and small cap stocks are down almost the opposite, 4%. But in this case, EEM is down and the EFA is down, so everything is down over the last 6 weeks. And the Qs are doing their own thing, and on the other, with other safety trades doing well, TLT is up there, the U.S. dollar is up there. The only safety trade that's not doing well is gold, because of the strength in the dollar that we've seen. So let's take a look at some of these other asset classes and how they've been performing here this week. Let's look at the U.S. dollar. You can see, going into yesterday, the big drop that we had in the euro, and flirting with that major support level that we've been talking about here, bouncing up today, and you can see the small little move we're making so far, as this candle will be mostly tomorrow. But you can see how it's still a bearish posture, still kind of a bearish tent to things on the euro, so bullish for the dollar. And then you look at like long-term bonds, and they're still kind of in up and down, but bullish mode. A little bit of a pullback here, with a sharp drop in short-term sentiment. But you can see it's bouncing to seeing whether or not this is going to continue to rise higher. If you look at gold, gold has been bullish and really kind of breaking out. And you notice we're at light green shading in the yellow line. So this is either a really bearish pattern or this is the reversal. If you take a look at some of these oscillators here, as we saw with TLT, they had made a parabolic run here with a strong move up, the biggest. It's been a while since the DMI, the positive directional movement index, was that high. You can see you have to go back to the COVID, and before that, this level here in 2019. Remember, we were in a bear market here. From a risk appetite standpoint, we were in a bear market from the fall of 2018 to the COVID low, and even really beyond a little bit, because that's what bonds keep going up even after the stock market hits its low point, generally speaking, when we're in bear markets. But you can see how many times during this run that the positive indicator made a strong move to the upside. But when we were in a bullish market from the election of 2016 into that fall of 2018, you can see it hardly ever got this high. There's only a couple of periods where bonds, and they were really kind of during these intermediate, as much of an intermediate decline as we had. So that's kind of what we're seeing here, an increase in strength in the long-term bonds that we haven't seen for a while. Now, we're not really getting the weakness on the negative indicator that we saw during that bear market, where you can see the negative indicator was well below 20 during these runs, and that's not quite the case here. We're above 40 multiple times, but we're not really getting a strong breakdown yet, at least below 20. So you take that with a grain of salt there. I wanted to show you the relative strength of small caps to large caps. Let me bring this up here, and we'll take a look at QQQ relative to IWM, and look at this move. And let's go to a daily chart, and we'll go down here to like this past year. Look how, again, just strong parabolic move. The MACD, the PPO is higher than it's been in a long time. We've been looking at that PPO and watching it to see how high it's going to get. Remember, this is the MACD, but normalized. The MACD can be changing because the numbers change over here. So, it's an absolute value, but you can see we're at 4%. That was the mark we kind of hit in these few peaks that QQQ had, most notably right before the September pullback, when it kind of went parabolic there right before September. So it's going parabolic again, right? Very high CCI, very high RSI that we haven't seen for a while. Again, we haven't seen that since March of 2000 and the COVID low point there. And again, the last time it was relatively high was going into that September again, the only intermediate decline we've seen since the COVID low point was September and October 2020, and that's about how high the RSI got. RSI is high again there, and you can see the CCI trying to potentially diverge here with the peaks that it's had lately over the last, these three peaks here, going into this peak, and that peak, all progressively higher with lower highs on the CCI. So relatively significant move in this relationship, really going parabolic. The MACD is not positive, and it hasn't peaked yet. You can see it's going back up. So there's still some run that this can go. And again, in the last 10 years, it hasn't gotten, there's only been a few times where it's gotten up above, and that was during the COVID, when it got up above 4%. And you have to go back here to 2011, during the credit crisis, right before the credit crisis actually, when it made a parabolic run as well up into that area, before, we had some weakness there at the end of 2011. Had a period of volatility there in the markets, kind of coinciding before and after that peak here in this strong above 4% peak. Remember, again, this is all normalized, and if you go back even further than that, out to a 20-year time frame, you can see again 4%. You go back, there's that 4% there. There's a run up to 5%, a little bit higher, and this was again the actual bear market decline of 2009. You got a couple other 4% here in 2007, one right before the peak in the stock market itself in October of 2007. So it's not, again, this is kind of usually in line with when things kind of peak here on risk appetite as a whole. I wanted to update you on this chart. This is the 50-day moving average, the number of stocks that are above the 50-day moving average, back below 50%, even though the S&P is not really declining, it's back below 50%. It's still below the mean, which again, usually this is the last time we were below the mean for a significant period of time, was last September, October, again, associated with declines, intermediate declines, when you're below the mean for that, long of a period of time. We were that way going into that peak. We were actually pretty positive going into, but once we hit that peak and rolled over, then we were down below the mean for quite an extended period of time, like we have been here recently. So looking at, well, really quickly before we look at the sectors, again, to see kind of like, is this just a QQQ thing that we've been seeing here? Again, we go back to the 12 major economies to see the discrepancy, and again, lots of light green shading, but red lines. Japan back to dark green shading and a green line. You still got some red lines with dark pink shading. Russia, the light pink shading and the red line, trying to figure out whether we're going to bounce off of that or not. Others that are bouncing up towards the moving average, but nothing else that looks like this, which is very, very unique in the U.S. And of course, you can do the same thing with the sectors, or pull up the 12 grid for the sectors. You can see where the strength of the markets are in, even though you're starting to pull back a little bit in discretionary, but that's where the strength of the market's in. You can see where the weakness in the market's at, in this middle row. And then you can see where some strength is coming into, especially on a relative basis here in the bottom row, with healthcare kind of holding up. So that brings me to back to this rotation graph here. And let's go to actually the sectors for SPY. And then again, you can see the weekly charts and the direction of these moves. XLK is right there. It's up in blue, trying to turn around. XLY is right there, going in the wrong direction. And XLC is trying to figure out what it's going to do too, but not really gaining or losing relative strength. XLK is gaining relative strength, but not over 100 yet, and it's still got, and it's just barely got a little bit of positive momentum. But these areas are all going down to the left, right? All going down to the left, and that's over you can see the last 6 weeks where there's been that discrepancy between the Qs and everything else. And you can see your safe havens, healthcare, real estate, utilities has been moving down, and then staples right there starting to move in the up to the right direction for a lot of these, and you would expect utilities will roll back up as well if that's going to be the case. Here's what utilities chart looks like on its own individual chart related to SPX or SPY down here. So there's that, again, how it's rolling back down on the relative strength line, but you get the idea that, this roll down might not be very long of a roll down if we were to turn back up into a bearish period, which is what happens. This relative strength line is above 100 when you're in kind of bear market, or at least pullback mode. At least it goes up in pullback mode, and we saw that last September in October, going into the end of October right there. And then its bearish momentum was done. So it's had a little pullback on momentum. Doesn't look like that pullback is going to last very long before it turns back up. And you see that in XLP as well. A little bit of a pullback in momentum, but it doesn't look like it doesn't have the sharp angle drop on it. And then XLRE actually has a little bit of pullback in momentum too, but has very strong relative strength. So you can see the safe havens. There's been a little bit of a pause in the safe havens as the market's been buying up these Qs as their safe haven. But you'll see how long that lasts, as these are at some pretty strong peaks on this current near-term run that they're both on, showing some clusters and being well above that 30-day moving average, and everything else not following suit and confirming that. Alright, and that brings us to our trade idea of the day, and I want to take a look at Netflix, which has really had a strong little breakout move over here since the end of last month, for about a month now, really taken off. Dark green shading, green line here. You can see the 3 green arrows on, we got 1 green arrow on the MACD, but good strong volume today. Looking at the 2 line versions of this chart, you can see that we've hit the peak on the MACD histogram. We've rolled over. We've hit the peak on the MACD itself, and we've rolled over. Now, it doesn't mean that we're going to stop going up, but in terms of the strength of this move that we've been in, it's a very strong move. If you look at the trend strength indicator, you're almost to strong trending levels. Above 80, almost above 5 there. Looking at the RSI and the CCI, you can see that. Okay, we're almost above 200, even though it's a little bit of a divergence there. Looks like we're trying to diverge again here on the RSI, but relatively extremely high for the RSI. And then you look at the directional movement index and you see, holy cow, the positive indicators really hit some high levels for the stock. The ADX has hit really high levels because that negative indicator is so low. We've really taken off to the upside. So that's an extreme gap, and you can also see that too in the Bollinger Bands for Netflix, that you've had a pretty wide band that has been starting to shrink a little bit. Even though we're trading still in the upper quartile, you'd expect that we'll start to trade more in the middle as the bandwidth comes down. That's what happens when the bandwidth comes down. You start to trade more in the middle of the bandwidth, and we contract. And you can see Netflix has got very strong support down below where we're at right now. It's got, we're on a good bullish move with some room to run to the upside. So what I've done is I've constructed this iron condor spread, selling the 20 deltas at 510 and 610, and then buying the 615 and the 505 for support. That's what you see over here. I'm trying to find where we ultimately get filled in. It's a big, expensive stock, so it's relatively wide spreads here. But then you can see where that's how that spread works for August expiration. I've put these break-evens on the chart, and that's where the break-evens are. So my lower break-even is protected by very strong support down below it, very strong support down below it. The upper break-even, it's got gives the stock room to run for it to really go up. With earnings coming up right after July expiration, we can get an idea of whether it's going to have that explosive upside potential or not, or whether we'll just continue to grind like we've done after the last few. You get this big move, and then ultimately just grind. Here you get the big move to the downside, but ultimately just grind going into the next expiration on both of these. So we have room for it to go up or down, and then ultimately just grind where it's at, and see if that ends up being the case one more time for Netflix on this particular earnings announcement. Alright, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Anybody can participate there, even our free subscribers. So open up any new threads with any questions or comments you have. Reply to other people's threads. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon, as well as like us on Twitter and Facebook too. And comment on the video. Have a great rest of your Wednesday night, everybody. And we'll see you all next time.